Welcome to this explainer. Look, I am absolutely thrilled you're here today. If you're a young adult looking to start your wealth-building journey, honestly, things can feel pretty intimidating at first. You hear all these crazy acronyms, you see flashing charts on social media, and it's super easy to feel like you need a finance degree just to get started. Well, as your financial mentor for this session, I'm going to completely strip away all that confusing jargon. Today, we're setting the stage for you to build long-term, literally life-changing wealth using some of the absolute best, beginner-friendly tools out there.
Okay, let's dive right into this, because right out of the gate we've got a bit of a fascinating mystery. Both VFV and ZSP are investments designed to do the exact same thing, track the top 500 companies in the United States. But check this out. Recently, VFV had a year-to-date return of 2.71%, while ZSP was sitting at 2.85%. This means if you put $1,000 into each, you'd have made $271 with VFV, but $285 with ZSP. They track the exact same index, yet they do not return the exact same growth. So why does that happen? Well, that is exactly what we are going to solve today.
Here is our roadmap for this session. We're covering 1. Decoding the ETF basket. 2. 5 rules for choosing. 3. The Vanguard option, VFV. 4. The BMO alternative, ZSP. And finally, 5. The tax smart play, HXS.
Section 1. Decoding the ETF basket.
We're building a rock-solid foundation here, starting right from square one, so absolutely nobody gets left behind. You hear the letters ETF all the time, right? It stands for Exchange Traded Fund, but I want you to just simply think of it as a basket. Instead of going out and buying hundreds of individual stocks, which takes a massive amount of time, a ton of research, and a lot of money, you just buy this one basket. The second you buy one index ETF that tracks the S&P 500, you are instantly diversifying your portfolio. You automatically own a tiny piece of the top 500 companies in the US, giving you instant exposure to heavy hitters like Apple, Amazon, and Tesla, all wrapped up in one incredibly efficient investment.
Section 2. 5 rules for choosing. All right, now that we know what the basket actually is, we need to understand that different financial managers handle these baskets very, very differently. This is the practical toolkit phase of our session, guys. If you have a notebook handy, I highly encourage you to write these 5 steps down. When you evaluate an ETF, you absolutely must look at its management fees, its dividends, its currency hedging, how it handles rebalancing, and its underlying holdings. This checklist is how you figure out where your hard-earned money is going to work the absolute hardest for you. So let's break down the most critical ones. Rule number 1 is the MER, or Management Expense Ratio. This is the fee you pay every single year to the company that manages your ETF. Now, you're not actually going to see a bill in the mail for this. You don't pay it directly out of pocket. It's already priced into the fund's performance. But make no mistake, this is the manager's cut of your wealth. So just applying some common sense here. Since this is a fee that directly eats into your profits, the lower the MER, the better. Always look for funds with incredibly low fees.
Next up is currency hedging, which is incredibly vital if you're a Canadian investor buying U.S. assets. Some ETFs are hedged, meaning they try to cancel out the currency fluctuations between the Canadian and U.S. dollar. But the catch is, those often come with slightly higher fees, and they can actually cap your upside. As a young, long-term investor, going with a non-hedged ETF is generally the stronger play. Why? Because if the US dollar appreciates and gets stronger compared to the Canadian dollar, your returns in a non-hedged ETF are actually likely to be higher. You definitely want to be exposed to those favorable fluctuations over the long run.
Then we have the absolute magic of rebalancing. This is a massive green flag for a hands-off beginner portfolio. Just imagine your ETF holds exactly 2 stocks, Stock A and Stock B, in a perfect 50-50 split. If Stock A suddenly has an amazing year and grows way larger than Stock B, the ETF manager will automatically sell some of Stock A at its high price and use that cash to buy more of Stock B at its lower price, completely restoring that perfect 50-50 split. They're automatically buying low and selling high for you, keeping your portfolio perfectly tracked to the market, and you don't even have to lift a finger.
Section 3. The Vanguard option, VFV.
Let's see how all of this builds when we apply our brand new toolkit to our very first real-world option, Vanguard's VFV. Look at that number right there, 0.09%. That is VFV's management expense ratio. That is incredibly low. We're talking absolute peanuts here. It brilliantly illustrates just how cheap it can be to have a massive institution like Vanguard do all the heavy lifting, the diversifying, and the rebalancing for you.
Looking a bit closer at VFV's fact sheet, it really hits a lot of our ideal criteria.
It's a non-hedged Canadian ETF, meaning you get that sweet U.S. currency exposure. It pays a distribution yield of about 0.95%, which just means you get paid roughly 36 to 37 cents for every single share you own, and that cash gets deposited into your account quarterly. Plus, it has a tracking error of only 0.2%. This basically means Vanguard is doing an incredibly accurate job of mirroring the actual S&P 500 index. It's straightforward, highly transparent, and just incredibly beginner-friendly.
Section 4. The BMO Alternative, ZSP.
But hey, Vanguard isn't the only player in town. It's super crucial as a beginner to know you have perfectly viable alternatives out there. When we compare VFE side by side with BMO's ZSP, honestly, they are remarkably similar. ZSP also offers that exact same peanuts MER of just 0.09%. The main difference you'll spot on their respective fact sheets is that ZSP currently has a slightly lower distribution yield, sitting at 0.88%. But here's the bottom line for you. If you're a beginner trying to maximize tax-advantaged registered accounts like a TFSA or an RRSP, both VFE and ZSP are absolutely fantastic foundational options to get your money working.
Section 5. The Tax Smart Play, HXS. Now, what happens when you graduate from beginner status and actually max out those tax-free accounts? That brings us to HXS. What's really fascinating here is how HXS handles the money it makes. Unlike VFV or ZSP, HXS does not pay you direct dividends. You're not going to see cash randomly appearing in your account every quarter. Instead, HXS acts as a reinvesting engine. It automatically takes those dividends and reinvests them directly back into the fund itself. So, why on earth would you want that? Well, because of taxes. In a standard taxable margin account, every single time you get paid a dividend, you have to pay taxes on it. But because HSX automatically reinvests that money instead of paying it out to you, it completely avoids triggering those immediate dividend taxes. Yes, the MER is just a tiny bit higher at 0.11%, but by reinvesting the money internally, it continuously pushes the overall value of the fund higher. It literally converts what would be taxable dividend income into highly efficient capital gains.
And this right here brilliantly illustrates the result of that tax-smart structure. Remember that mystery from the very beginning of our session? Well, this is the answer. When we look at the year-to-date capital returns, VFE sits at 2.71%, ZSP at 2.85%, but HXS is currently riding at 3.7%. Because HXS reinvests those dividends to pump up the share price rather than paying them out, its capital return looks higher on paper. It's a slightly different method of matching the S&P 500, but it is uniquely structured to give you a massive edge if you're investing outside of your registered accounts.
So here's your master cheat sheet for making your first big investment choice. If you're just starting out and using a TFSA or RSP, VFF and ZSP are your absolute go-to choices with their ultra-low fees and quarterly payouts. But once you level up, max those out, and move into a taxable account, HXS becomes your highly efficient best friend to legally shield your growth from those immediate dividend taxes.
I want to leave you with this core philosophy from our source material today. Our job is to put our money into the ETF where we can get paid more. Building wealth isn't just about trying to pick the right stocks, it's about being incredibly smart with your fees and your taxes. Because every single dollar you save in management fees and every dollar you legally shield from the taxman is another dollar that stays right there in your portfolio, compounding year after year for your future.
The knowledge is literally in your hands now. Your next step is simple. Choose the right account, find a low-cost broker, maybe one with zero commission trading like Moomoo to keep those costs even lower, and just make your first move. You've got the tools, you know the rules. So I have to ask, which S&P 500 basket are you going to choose to start your wealth-building journey today? And more importantly,